Stop what you're doing right now because something is happening in silver that we haven't seen in over 45 years. And if you've been watching precious metals, if you own even a small position, if you've been waiting on the sidelines for the right moment to act, the next 15 minutes could fundamentally change how you understand this market and what it means for your wealth. It's Thursday, January 29th, 2026. Silver is trading at $119 per ounce. Not a prediction. Not something a newsletter predicted last month. The actual market price right now, today, in the past 30 days alone, silver has climbed 60%. Over the last 12 months, we're looking at 275% gains. This represents the strongest monthly performance since 1979, when the Hunt brothers attempted to corner the entire silver market, a move that eventually collapsed into complete chaos. And here's what concerns me most. Most people watching this move have absolutely no understanding of what's actually beneath it. They see the price going up, they hear the news coverage, they feel that anxiety creeping in, worried they're missing something huge, but they don't comprehend the actual mechanics. They don't understand what's really moving these prices. And that's dangerous. Because when you don't understand what's driving price movement, you can't distinguish between genuine structural change and temporary speculative excess. You can't make decisions. You just react. So today I'm going to walk you through exactly what's happening in this silver market. Not the headlines, not the hype, the actual structure. I'm going to show you why this moment looks genuinely different from previous rallies. I'm going to break down what the real supply and demand numbers are telling us. I'm going to explain what major financial institutions are projecting and why they're so divided on what comes next. And most importantly, I'm going to give you a framework for thinking about volatility that separates people who make money in bull markets from people who give back all their gains on the way down. Stick with me because this matters. I'm the voice of metal markets. And I want to build something specific in this space. I want to build a community of people who think clearly about precious metals. Not a place where we chase hype. Not a place where we worship at the altar of every price move. A community where we actually analyze what's happening, where we prepare methodically, and where we make decisions based on understanding instead of emotion. If that's what you're looking for, subscribe right now. Drop a comment below. Tell me what you're thinking about silver right now. And if you want real-time market updates before they hit YouTube, before the crowd sees them, join us in our Telegram channel. The link is in the description. That's where we break down what's moving markets when it happens. Now let's get into what's actually different about this moment. For most of the past decade, silver was treated as little more than gold's appendage. Gold would move up 50% and silver would follow. Gold would consolidate and silver would consolidate. The relationship was so consistent that most analysts treated it as purely mechanical. But something fundamental has shifted in how the market is pricing silver. Silver is now being understood as an asset with its own supply and demand dynamics. It has its own industrial consumption patterns. It has its own investment case that is increasingly separate from gold. This distinction is critical because it changes how we should be thinking about the metal. Gold just hit $5,500 per ounce. That's an 81% return over the past 12 months. Research from RBC is now circulating projections that gold could approach $7,100 if the current momentum continues. That's the backdrop. Hard assets across the board are being repriced. Trust in paper currencies is eroding. Government deficits are persistent and growing. Geopolitical tensions are escalating, and investors globally are looking for assets that cannot be printed, cannot be devalued, cannot be manipulated by central banks. But here's what's different with silver. Gold is being hoarded. It's being purchased as insurance, as wealth preservation, as a store of value that protects purchasing power. Silver is being consumed. It's being used up. It's being incorporated into products and processes in ways that remove it from the available supply permanently. This is the detail most investors completely miss, and it's crucial to understanding what's happening right now. According to data from the Silver Institute, the world produces roughly 813 to 835 million ounces of silver annually through mining. That production number is relatively stable. It doesn't jump around wildly year to year. Meanwhile, total global demand for silver sits between 1.12 and 1.16 billion ounces every single year. Do the arithmetic. Demand is exceeding supply by somewhere between 280 and 350 million ounces annually. Not a rounding error. Not a minor imbalance, a structural deficit of nearly a third of total production. And this isn't something that happened recently. We've now recorded 7 consecutive years of supply shortfalls. 7 years, not a temporary disruption during a specific crisis. A persistent structural deficit that is actually getting worse, not better, even as prices have risen. Where is this silver going? That's the question that reveals everything. Solar panel manufacturing consumes somewhere between 120 and 125 million ounces of silver annually, and solar production is not slowing down, it's accelerating. The transition to renewable energy means solar deployment is growing double digits year over year. Electric vehicle manufacturing adds another 70 to 75 million ounces on top of that. Every EV battery contains silver. Every vehicle built depletes the available supply. Then you layer in 5G infrastructure rollout globally. You add medical device manufacturing. You include electronics and semiconductors. You account for antimicrobial applications in hospitals and textiles. And suddenly you see why this shortage isn't a temporary situation. The demand is structural. It's connected to real economic activity that's not going away. And the shortage is tightening, not loosening. Now add another variable that most people haven't fully grasped yet. China, which is one of the world's largest silver producers, made a significant policy shift. On January 1st of this year, new export licensing requirements went into effect. Silver is now classified as a strategic material in China. That means the world's second largest economy is actively restricting how much silver leaves its borders. Think about what that does to global supply when you're already running a 300 million ounce annual deficit. You're already drawing down above ground inventories. You're already consuming more than you produce. And now one of the major producers is restricting exports. The supply problem doesn't get better. It gets mathematically worse. This is not speculation about what might happen. This is arithmetic. This is what the numbers show us right now. We have structural demand that exceeds supply by a meaningful amount. We have 7 years of deficit data showing this is persistent. We have industrial demand connected to real economic activity. And we have one of the major producing nations restricting export flows. The question isn't whether there's a supply problem. The question is what price it takes to ration demand or bring new supply online. Now here's where I need to be completely honest about what this means for price direction from here. Does silver go straight up from 119? No. Markets don't work in straight lines. Anyone telling you that this is a one-way move upward is either trying to sell you something or doesn't understand how price discovery works in fast-moving markets. When you see a move this powerful, 275% in a year, 60% in a month, you attract two completely different types of capital, and their behaviors are opposite. The first type is structural capital. These are long-term investors and institutions that understand the supply and demand story. They believe this deficit is real. They believe it plays out over years, not weeks. They're accumulating physical metal or gaining exposure through quality mining companies. And when price drops, they don't panic. They see it as an opportunity. They have a thesis and they execute it patiently. They don't chase. They don't sell into fear. They have a plan and they stick to it. The second type is momentum capital. This is fast money. This is algorithmic trading systems. This is retail traders seeing headlines about silver hitting all-time highs and thinking they're missing the trade of a lifetime. This capital moves fast in both directions. It enters on greed, it exits on fear, and when it exits, it doesn't give a warning. It just leaves. And that creates a specific type of market dynamic. Right now, both types of capital are present in silver, and that combination creates something worth understanding. You get significant swings, you get violent reversals. You get the kind of price action that makes confident people suddenly doubt their thesis and makes cautious people suddenly chase into rallies they swore they'd never chase. A veteran trader and market analyst named Peter Brandt recently pointed out something revealing. More than 1.5 billion ounces of silver have traded hands on exchanges in recent months. That's nearly 2 years' worth of global production flowing through the market in a compressed window. The last time we saw turnover at that level was in 2011, right before silver collapsed from near $50 an ounce down to under 15. Now, does that mean we're at a top? Does that mean this rally is finished? Not necessarily. But it means something important. It means you need to respect the volatility. It means whatever position you're taking needs to be sized appropriately for the kind of swings that are coming. It means you need to have thought through what you'll do in both directions, not just the direction you're hoping for. Here's how I think about fast-moving markets like this. The people who make the most money aren't the ones who predict perfectly. They're the ones who prepare for multiple outcomes. They say to themselves, if silver breaks higher from here, here's exactly what I do. If silver pulls back 30 or 40% to shake out weak hands and test everyone's conviction, here's exactly what I do. You make those decisions when you're calm and thinking clearly. You don't make them when the market is moving fast and your adrenaline is pumping, because in that moment, the market is specifically designed to trigger the worst version of your decision-making. Now let's look at what the big institutions are actually saying right now, because the range of their opinions is telling. It shows us that even the professionals don't agree on what comes next, and that's actually important information. On one side of the debate, you have former JP Morgan strategist Marko Kolanovic. His thesis is that silver has gotten ahead of itself. His argument centers on momentum-driven trading and speculative positioning outpacing any real change in the underlying supply and demand picture. He's not saying the supply deficit is fake. He's not saying industrial demand isn't real. He's saying the price has moved faster than the fundamentals warrant. And his projection is that silver could pull back 50% within a year. That's a meaningful call. On the other side, you have research from Krupp, a firm that tracks precious metals markets closely. They're raising their near-term price target for silver to $150. Their reasoning is straightforward. 7 years of supply deficits, record industrial consumption driven by renewable energy and EV production, and a market structure that still looks structurally tight even at current price levels. If you accept the supply and demand story, their thesis makes sense. Then there's HSBC, sitting somewhere in the middle. They acknowledge the rally is real. They note that supply and demand fundamentals are challenging, but they caution that much of silver's rise has followed gold higher on broader hard asset strength. They point out that momentum trading has intensified, and they warn that higher prices could eventually dampen industrial demand while encouraging more recycling and bringing marginal supply back online. Their view is that the situation is more complicated than pure bullishness. So who's right? Here's the honest answer. They might all be partially right at different points in the cycle. Kolanovich is absolutely right that momentum markets can reverse violently. We've seen it happen. We'll see it happen again. But being right about the possibility of a pullback doesn't tell you when it happens or how much higher we go first before any pullback occurs. His analysis is correct but incomplete. Krupp is right that the supply picture looks genuinely constrained. You can't just build new silver mines overnight. There's a reason we've had 7 consecutive years of deficits despite rising prices. New supply requires time. It requires capital. It requires permitting and development. And meanwhile, demand isn't slowing down. It's connected to real economic trends like renewable energy and EV adoption that are accelerating, not decelerating. Their analysis is also correct. HSBC is right that eventually, higher prices change behavior. Eventually, manufacturers look for silver substitutes. Eventually, recyclers become more aggressive. Eventually, enough marginal supply projects become economic to develop. But eventually can be a very long way away when you're starting from a position of persistent undersupply. Their caution is warranted, but it doesn't negate the thesis. The point is that the next major move in silver isn't predetermined. It's not written in stone. And if you're looking for certainty, you're looking for the wrong thing. What you should be looking for is a position that makes sense across a range of outcomes. What you should be building is resilience, not predictions. Let me shift to something many people overlook when they're focused on price. If you believe the silver deficit story is real and structural, then one question becomes absolutely critical. Where do the ounces come from? Because think about this logically. Above-ground inventories are being drawn down. Mine production isn't growing fast enough to match demand. And now, China is restricting exports. So where does the silver that fills this gap come from? The only realistic answer is new mine development, companies that have silver deposits in the ground, companies that have the capital and capability to develop them, companies that are positioned to benefit from exactly the kind of supply crunch that the market is pricing in. This is why investors and analysts are starting to pay attention to exploration stage silver companies that have real resources in good jurisdictions. Not because every junior explorer is going to become a major producer. Most won't. But because the ones that have genuine ounces in the ground, that have realistic pathways to development, and that have the capital to execute become strategically important in a supply-constrained environment. I want to be clear about something before I continue. Nothing I'm saying is financial advice. I'm walking you through the logic of what makes a silver company interesting in this environment. You need to do your own research. You need to understand your own risk tolerance. You need to make decisions based on your situation, not mine. That said, the framework is worth understanding. A silver exploration company has several characteristics that matter in a constrained supply environment. First, the quality and size of the resource. You want companies with substantial ounces, ideally in the high-grade category, because that changes the economics dramatically. Higher grades mean lower costs to produce. Lower costs mean projects become economic at lower prices. Second, the location matters enormously. You want assets in stable, mining-friendly jurisdictions where permitting and development can actually happen. Third, the company needs capital to actually execute on the thesis. An exploration company sitting on great silver but without funding to drill and develop it is just a real estate holding, not an active business. Finally, you want a clear calendar of catalysts, drill results, resource updates, feasibility studies, real market-moving events that give investors reasons to keep paying attention. When you think about what makes a silver story work in 2026, it's companies that check those boxes. Quality resource, good jurisdiction, funded to execute, clear catalysts ahead. Let me zoom back out because this specific company discussion is less important than the macro picture. What's happening in silver right now is a genuine structural repricing. The supply deficit is real, the industrial demand is real, and the supply constraints are actually getting worse as major producers restrict exports and above-ground inventories continue to deplete. That's the story. At the same time, the price action has become volatile enough that it's shaking out weak hands. It's punishing over-leveraged traders. It's creating fear. And that volatility is not a bug. It's a feature of bull markets. Bull markets climb walls of worry. They punish impatience. They force you to actually earn your gains by surviving the swings. That's how markets separate serious participants from people just chasing headlines. So let me give you two scenarios, and I want you to think about what you'd do in each one because only one will happen, but you need to be prepared for both. Scenario 1. Silver consolidates around these levels, digests the recent gains over a few weeks or months, and then breaks higher toward 150. The breakout gets confirmed. Mainstream financial media floods the zone with silver coverage. Late-stage retail investors pile in. Physical demand spikes. ETF inflows accelerate. And anyone who bought on weakness looks like a genius. If this happens, you need to know in advance when you'll take partial profits. You need to know how much exposure you're willing to hold through the next extension higher. And you need to have enough discipline to resist the urge to add more size at the top of the emotional cycle when everyone around you is talking about silver going to 200. Scenario 2. Silver does what it's done before. It rips violently lower in a shakeout, not 30%, maybe 40, maybe more. Enough to trigger margin calls, enough to hit stop losses, enough to create real panic selling. The news narrative flips from euphoria to doom overnight. People who bought at 119 find themselves underwater and questioning everything. And then, after maximum pain is inflicted, the market reverses, and the real next leg up begins without those people. If this happens, you need to know what you'll actually buy. You need cash set aside for the dip. You need emotional preparation so that when prices are falling and fear is highest, you don't panic sell and cement your losses. And you need to understand that shakeouts aren't the end of bull markets. They're actually the fuel for the next leg. They reset sentiment. They clear out weak hands. They create the conditions for the next push higher. The goal isn't to predict which scenario happens. That's impossible. The goal is to be positioned in a way that you can survive both, to keep your position sizing small enough that you don't get stopped out on normal volatility, to keep your expectations realistic enough that you don't turn a winning position into a painful round trip, to have a process that keeps you in the game, regardless of which direction price moves next. Here's the mindset shift that actually changes everything about how you'll perform in this market. Volatility is not a sign that something has gone wrong. Volatility is the price you pay for exposure to an asymmetric opportunity. If you want upside that's dramatically larger than your downside, you have to accept swings that feel uncomfortable. If you want the 36 ounces that could come from silver hitting 200, you have to be able to handle the drawdowns that come along the way. The people who can't psychologically handle those swings get removed from the trade. The people who can handle them earn the right to stay and benefit from the thesis. This is where I see most people fail. They hear about silver at 119, and they immediately think about all the money they could have made if they'd bought at $30. They feel regret. They feel urgency. And that urgency pushes them into making impulsive decisions that don't fit their actual risk profile or their actual financial situation. If you're not in yet and you feel FOMO, don't chase. Markets almost always offer entries through dips, consolidations, and corrections. Patience is the real edge. The people who buy the pullbacks will statistically do better than the people who chase the breakouts, even if the breakouts lead to significantly higher prices. That's just how volatility works. If you are already in a position, don't let volatility bully you into making reactive decisions. Respect the swings. Understand they're coming, but don't surrender your thesis just because price moved against you. Know what you own. Know why you own it. Know what specific information would have to change for you to actually sell. And make that decision when you're calm, not when the market is moving and your emotions are running hot. Here's something to watch in the sessions ahead. If you see silver dip hard and then snap back quickly, that's a signal that demand is waiting underneath. It means buyers are stepping in on weakness. That's bullish structure. That shows conviction. But if you see silver rally and then stall right under a key resistance level for multiple sessions, that's the market loading the spring. Energy is building. And when that energy releases, it tends to move faster than people expect. Watch the reactions. Watch how fast the market recovers from dips. Watch whether sell-offs get erased within hours or whether they linger for days and weeks. That reaction speed is often the real signal about whether the move is being driven by conviction or whether it's running out of fuel. Let me address two questions I've been getting because they're directly relevant to what we're discussing. First question: If silver is so strong and the fundamentals are so tight, why does the price feel like it's trying to throw everyone off every other day? The answer is that the market's job is not to make you comfortable. The market's job is to move price to where it can find the next buyer or seller. And in fast-moving phases, it does that by creating fear, then relief, then fear again. It's emotional conditioning. The only way to beat that pattern is to have a decision-making process that removes real-time emotion. Have a plan. Execute the plan. Don't make decisions based on how the price movement made you feel. Second question I get a lot. Should I be in physical metal or should I be in paper exposure? Should I own bars and coins or should I own ETFs and mining stocks? Here's my take. Physical metal is for people who want direct ownership without counterparty risk. It's slower, it's less liquid, it's not designed for rapid trading. You buy physical because you want to own metal that physically cannot be frozen by governments, cannot be diluted by inflation manipulation, cannot be defaulted on by a counterparty. Paper exposure through ETFs, futures, options, or mining stocks gives you liquidity and quick execution. It gives you leverage to the price movement, but it comes with margin requirements, with counterparty risk, with rules and regulations that can change at the worst time. Match your exposure to your personality. If you can't sleep at night when prices move sharply, don't use leverage. If you struggle with impulse control, don't use options. If you want long-term protection, and you don't care about optimizing every entry and exit, stack physical metal and think in years, not weeks. Let me bring this back to the core message because we're getting close to the end. Silver at 119 is not a top. It's also not guaranteed to go higher tomorrow. What it is a signal. A signal that the market is finally repricing an asset that has been suppressed by years of complacency and low interest rates. A signal that supply and demand fundamentals are finally being recognized and priced in. A signal that the relationship between gold and silver is evolving into something new. The days of silver being a pure derivative of gold are over. For this environment to make sense, you need to think in terms of years, not months. The supply deficit didn't develop overnight and it won't be solved overnight. Industrial demand is structural. It's tied to economic trends that are accelerating, not slowing. And above-ground inventories are being drawn down consistently. That's the backdrop for the next several years, not just the next several months. So here's my challenge to you as we close. Get clear on your thesis. Not my thesis, your thesis. Why do you actually believe silver is worth owning right now? Get clear on your position sizing. What can you afford to lose if this move reverses violently? Get clear on what you'll do if silver goes up and what you'll do if it goes down. Write it down if you have to, because the next few months are going to test your conviction. The people who win in this phase won't be the loudest voices. They won't be the ones who predicted the move perfectly. They'll be the ones who were most prepared. They'll be the ones who understood that volatility is not a threat, it's a filter. A way for the market to separate serious participants from tourists. That's what this moment is. I want you to do something specific for me in the comments because it genuinely helps me understand what this community needs. First, tell me your thesis. Do you think silver breaks through 150 cleanly, or does it shake everyone out with a brutal pullback first? I want to hear your reasoning. Not just your guess, but your actual reasoning. Second, tell me what exposure you're holding. Physical, ETFs, mining stocks, options. What's your time horizon? What are you actually trying to accomplish? And third, if you've had any kind of success in precious metals, whether it's as an investor, as a trader, or even just as someone who survived a drawdown without panicking, share what you learned. Your experience might be exactly what someone else in this community needs to hear today. Before I go, I need to ask you directly, did this video help you think more clearly about what's happening in silver? Did it give you a framework you didn't have before? If it did, then subscribe right now. One click. It tells me that this analysis is worth continuing. It keeps me making these deep dives instead of chasing trends for views. Also join us in the Telegram channel. The link is in the description. That's where I post real-time market notes, quick chart analysis, and sometimes my raw thoughts before they become full videos. If you want to react before the crowd, that's where you need to be. Follow Metal Markets on X as well. When something is moving fast, when silver does something significant overnight, you'll hear about it there first. YouTube's upload process is too slow for real-time updates. Here's the final thought I want to leave you with. We are at one of those moments that people will reference years from now. When someone asks you about the 2026 silver run, what will you tell them? Will you say you watched from the sidelines because the move seemed too big? Will you say you chased in near the top and got shaken out, and that experience taught you something important about yourself? Or will you say you understood what was happening, you sized appropriately, you prepared for volatility, and you stayed in the game long enough to benefit from the thesis? That story isn't written yet. You're writing it right now with every decision you make. Silver is at 119. Gold is at 5,500. The market is telling you something. The only question is whether you're actually listening. Stay focused, stay prepared, and I'll see you in the next update.